Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday time. As we wind down here towards the end of the year, let's take a look at the institutional crypto flows. Finally breaking the inflow streak this week, having a $16 million outflow, as James from CoinShares says here. He believes it to be more profit-taking than a swing in sentiment. And generally, I'd probably agree. As price moves up quickly, the propensity for people to take profit is kind of just in your face. You know, if you're up 2x on a position over the course of a month and momentum slows down, you're more likely than not going to start rotating things around, especially if US indices are at all-time highs. So if you're not holding a long-term time horizon, which inevitably some of these inflows won't be in the long term, they'll be in the short term, they'll want to take profit. If we look at which products flows were coming out of, mostly Bitcoin and ETH, some inflows into Solana, some outflows into short Bitcoin, out of short Bitcoin, and kind of mixed across the board regionally, most of it coming out of United States and Germany. And just looking at that BTC product, which is the inverse Bitcoin strategy, I believe it's correct to assume if it was a perfect inverse one-to-one, BTC should be down, pretty considerably. With fees on both BTC and BitX, these aren't going to track exactly how you'd expect. This is the 2x ETF, so it's going to be close. I just hope that when that time inevitably comes for a Bitcoin short, BTC remains available. It'll be a great top signal if they end up closing this product somewhere in the six-figure range. I don't know what on their end is deemed acceptable. I assume it needs to have a specific AUM, but eventually, if this is a real deal bull run, this product is going to just look really, really bad. As a short-term hedge, it's probably more attractive versus a long-term hold, unless you're just, look, if you're bearish Bitcoin, there you go. There's your Bitcoin short. And we also had this come out of Bitwise today, a 15-second commercial discussing ETFs specifically. So I don't expect that they're expecting to get denied. And the commercial's already starting. So this feeds into the early January narrative for an approval. Based on the length of this commercial, we may even see this in the Super Bowl. I don't know if anybody's really said that down here, but we'll see where it shows up. Interesting that they are seemingly super confident that they're going to get approved. Joey, in the last video, commenter modder extraordinaire, had asked about pre and post halving price action for Bitcoin. And look, you can be in the halving doesn't matter camp. That's fine. That's not historically what the data has said. The past doesn't predict the future, but it often rhymes. So if price has accelerated quickly post halving in the past 3 halvings, I will currently pencil that in for probably likely to see something similar for the next halving in April. As far as the economic calendar, because it's the end of the year, not too much going on. I think the big one is PCE at the end of the week. Maybe some GDP stuff Thursday, but all in all, it's light. Nobody wants to work. Nobody wants to do anything. It's holiday time, not macroeconomic data time for the most part. An interesting metric that's cropped up twice now is the number of elections happening in 2024. And I've never really thought about it like this, but very interesting chart showing the percentage of global population with legislative and presidential elections. And next year coming up, it's going to be almost 50% of the world having some sort of election. Japan in there as well, most likely. So it's going to be a super, super interesting time. And then, of course, if we bring that back to Bitcoin, Platazao, who's just chronically underfollowed, great charts, great data, consistently, go give him a follow. Put together this chart, presidential elections, halving, and how these have lined up historically, and how, is one leading the other here? Is it both? Is it neither? I don't know. Again, historically, we have seen price accelerations relative to the presidential election as well. And we can say, well, this is because in the election year of an incumbent, they're more likely to increase liquidity. They're more likely to give out stimmies to both corporate and Main Street. Sure, I'll take it all. Either way, the conclusion is the same. So just something interesting to think about there. US trueflation has ticked down a little bit. This is a real-time estimate of inflation. For the most part, though, hovering in the threes, the low threes, the high twos, let's say. Interesting that even on trueflation, we have not returned to 2% at any point here. We got close, we got super close, but we've been really unable to squeeze out that last mile, as they say. So will this be good enough for the Fed to actually say that they've achieved their goals? Will they change the inflation target from 2% to 2.5% to 3.5%? There's lots of things they could do here, or they could focus on PCE or core, whatever, super core, maybe rationalize it that way. But we're still not quite there on this side of the pond. Now in the UK, things have improved dramatically with trueflation sitting at a 1-year low. So that's great news for them over there. And if we look at all of the inflation gauges, they all are ticking down. So we're headed in the right direction. You know, I'm not going to say the D word today. I'm not going to say it, but there are certain people who are continuously bearish, which is fine. You can have a worldview and a direction in mind, but I don't think those people are going to do well when the data looks like this. So we're not there yet. We're getting there. I didn't believe in a soft landing either. I still don't. So if it happens, great. If it doesn't happen, whatever. But it's certainly looking like that based on the numbers that were given here. Another interesting one is the misery index. If you look at the unemployment plus the CPI, I think this was created in the 70s when the misery index was in the 20s. So the misery index is down back near lows. And, again, if you don't believe in the unemployment numbers, fine. You're not going to believe in the misery index either because it's using that data. And if you don't believe in CPI, fine. I'm right there with you. I just don't think that's going to help you make great trading decisions. If we look at the inflation expectations for this month, which are released next month, this does show a slight tick higher. So again, similar to trueflation, into the mid-ish threes. So there's no Fed meeting in early January, right? It's towards the end of the month. So it'll be interesting how these 6 rate cuts change and shift relative to the inflation data, which is going to say, oh, maybe that's right. Maybe we're not quite there. Maybe the Fed will have to hold a little bit longer. And at the same time, Powell could come out and say, well, 1 month a trend does not make, and we're still headed in the right direction. What's going to be more interesting to me is on the day when CPI gets released in January. How's the market going to react to that? Are they going to assume that they can start to price out these cuts, or are they going to leave these in? I don't know. At the end of the day, it doesn't really matter, but it's just going to be interesting what the market reaction is going to be on that day. Because again, and I don't know why, but it seems like people just don't pay attention to this data or trueflation or anything. I don't know, if there are any efficient market hypothesizers in the chat, let me know because I don't know what's going on there. A quick look at reverse repo, just as we do every week. Reverse repo came down to its lowest level since the highs in mid-2023. This is sort of offsides capital from mostly money market accounts that were seeking short-term yields that have shifted into longer but also short-term yields through US Treasuries. This has acted as a liquidity spigot for risk. This has helped refill the TGA, and risk hasn't really felt a lot of pain despite the debt issuance because of the drain in reverse repo. And Bianco put out a couple charts last week illustrating the money market dominance in reverse repo, and his rationale for reverse repo not draining completely to zero is because money markets use this ultra short-term overnight facility for redemptions. So if you're a money market fund, you have an option of getting overnight, short-term, or longer-term yields through various means. And you don't want to lock everything up in longer-term yields. You want a higher yield anyway. So some of this money market fundage is likely to stay in there just to meet those redemption requests. Another way to look at the change in behavior of these money market funds is the average maturity, which has increased pretty significantly recently. So again, that says it's moving out of overnight into longer term products. Another interesting reverse repo, just to hit that liquidity point home, if you take the reverse repo and you invert the scale, so the top here is 0 for the white, which is reverse repo, and you look at the Bitcoin price, the S&P price, this is never going to be 1-to-1 liquidity is never exactly one-to-one correlated, but the general idea and the gist of what's going on here seems pretty obvious. As the reverse repo filled up, as short-term rates increased, the S&P, Bitcoin fell, risk markets were punished. And now as money markets are trying to lock in that short-term yield, they're moving out of the overnight stuff because they have that option. And that's funding the TGA and acting as a liquidity injection. So the TLDR here is we should expect to continue to see reductions in reverse repo. Probably doesn't go completely to zero. So that does mean we probably still see further injections of liquidity into early next year. Looking at GDP as well, GDP estimates have jumped to 2.6. So again, the soft landing crew is continuing to collect their W's here, even though, again, I know the common retort is the data isn't real. I mean, look, the data is what we have. I don't know what to say, right? Tell that to the market and all the market participants that the data isn't real. I don't think they care. Like the market's going up anyway without you. And if we look at other indicators as a group, as a basket, that would suggest recessionary conditions, we're just not seeing it, right? Everything here on this list is pretty much up and to the right or recovering, and it really does not look like there's a lot of pain here just yet. That could change. That could change next year easily, but so far, we're just not seeing it. Another caution for next year, I think, is this China comparison. If we look at all of the deflationary periods for China, they have led to global problems. So we're currently teeing ourselves up for one such global problem, and something along the same lines of that is the reduction in the money supply to this degree has historically led to problems, right? And it's either been recession or depression, but for the most part, we've had issues trying to bring down the money supply like we did over the past couple of years. Looking at the yield curve, still inverted, still looks okay, right? Like, look, I'm right there with the recessionistas that we're going to get one, but we're not quite there yet. I mean, I don't know what else to say, right? Unemployment, as we found out a couple weeks ago, ticked down a little bit. And historically, we haven't had a recession until the uninversion. So for me, on the risk side of things, we've got some time. If we look at the student loan data, just a hard 180 here on if borrowers are paying or not. A couple months back, I think we talked about when we'd start to see evidence and data for a lack of repayment. And we're just starting to see that now. I don't have like great numbers here, but as the Bloomberg article states, looks like 40% of borrowers did not start their repayments, and that's 9 million people. So that is pretty considerable. Let's move on to some charts here. And, again, it's hard to be bearish when everything's at an all-time high. It's just, kind of that simple. Kind of super, super left curve here, but gold made an all-time high a couple weeks ago. Admittedly, the monthly candle doesn't look great, but fortunately for gold, it's got a decade-long cup and handle that it's working on here. It still looks fine for continuation. If you're trading gold, you're probably not expecting a gold rush rim shot on that one in price. Okay, like, this isn't going to move quickly, but this does look like it will lead to continuation. If we zoom in a little bit on the weekly, we're holding above 2K now for 3 straight weeks. So gold looks fine. I wouldn't touch it. This is from James Lavish. Over the weekend, he was comparing Fed cuts to prices in gold, and maybe the Fed pivot will lead to that 3K target in gold, right? If we could dial it back a little bit to the measured move here, maybe that's what it's going to be the catalyst to move gold higher finally. Another interesting gold chart was gold versus the NASDAQ. I love these relative value charts because it really makes me think about where the best place to put capital is, where the best place to allocate, where's the opportunity versus opportunity cost. Immediately I'm thinking about ETH BTC, right? Not really a similar chart, but a similar idea where this does continue to look bearish here, and it may need to retest old levels before things start going again. And this would maybe line up with heavy continuation here in NASDAQ versus maybe some lagging in gold. And then when the Fed actually pivots, maybe in Q2-ish next year, maybe that's when gold starts to bounce relative to the NASDAQ. But it certainly looks like gold is continuing to lag the NASDAQ there. And then there's oil, which just, shooting from the hip here, this whole thing could be a multi-year head and shoulders. Wouldn't that be something? This is the 200 week moving average in the red here, and it's really held on for dear life at the 200. Historically, if you zoom way out, the 200 for oil is actually super important on the weekly. Most of the downtrends have kicked off with losing the 200. So I think something to watch into 2024 is maybe another shoulder or two, but nothing higher than 90, 95, and then an eventual loss of the 200 week moving average to move lower. That doesn't make a lot of sense, but just based on what's going on in the world, that's what TA would probably suggest. As long as we don't make a higher high here in the 90s, there probably is some attempt to bring this lower, especially if the SPR gets filled up in the 70s, which we're nowhere close to that now. But again, it's kind of an if this then that situation into next year. But that chart at first glance does not look bullish to me at all. Another plaid, whatever it is. None of your business, whatever his name is. Great charts. Another one of his comparing all-time highs again in the indices versus Bitcoin. I'll add gold to this as well. So it's even hard to be bearish Bitcoin as much as we're up, as quick as we're up this year. I tend to think that Bitcoin will, digital gold, will pull up here towards the all-time high levels in Q1, especially if we have ETF approvals. This is the S&P, and again, yes, we're on the 7th week of bullishness, 8th week, whatever this is, super rare to see that on the S&P. The pattern looks great. Breaking the yearly pivot looks great. There's some suggestion that the short squeeze is over, which could be. This week could close red, but I'd imagine there's more shorts with stops at all-time highs as there usually is. So even if this is a down week, you've got to think that there's tons of people with stops at all-time highs. In any event, this is a cup and handle all day. It looks great. If we look at some of the year-end predictions for next year, Yardini, Fundstrat, Oppenheimer at the top, JP Morgan towards the bottom there. But, if we test 5,400, 5,800, I don't know if we finish the year there, but some of these estimates, most of which are based on fundamentals and not technicals, most likely are, to me, quite low based on where we could go throughout 2024. Qs look similar, just look fantastic. I think today this will probably close at an all-time high. Glad looks great. Targets look great. Really nothing to complain about other than the eventual likelihood that this week or the week after doesn't close green. Now we did have a string of green weeklies in here. 1, 2, 3, 4, 5, 6, 7, 8, 9 at that time. Something like that. But eventually there's a logical point where it just doesn't make sense to continue based on RSI and other things. People just get nervous, right? But we still look great for continuation there. Moving on to some of the individual stuff. NVIDIA, still defying gravity, looks fine, looks ready for all-time highs. Would be curious to hear everyone's year-end NVIDIA price predictions. To me, this looks like a good short if it breaks down below the daily cloud, but right now, looks totally fine for all-time highs. Then we've got Amazon, which to me looks also one of the best setups out there right now. Inverted head and shoulders all day above the weekly cloud. We're going to get a bullish Kumo twist here pretty soon above the yearly pivot. To me, this looks like it's headed for all-time highs eventually, right? You're probably going to see some pullbacks here, whatever, but it looks great, looks phenomenal. You're probably going to see some resistance at the 160, 170s, but the measured move of this pattern definitely points higher. Tesla kind of has a similar vibe to it. I feel like there's both a lot of extreme sentiment people out there with Tesla. They're either super bearish or super bullish. This could end up being a cup and handle, could end up being inverted head and shoulders. The cloud is going to start to like it more here. It survived going into the cloud, so I think this does tend to lean more bullish than bearish, especially if the entirety of the market is bullish. Something to watch for next year is if workers try to unionize, which I hope they do in Tesla's case. That may hurt the price here, but still looks great from a technical perspective. Coin almost hitting its inverted head and shoulders target if measured from 108 to 30. Target there is 156, 185. If you are a cycle believer that the cycle is going to be big, Coinbase is going to see a lot of revenue from fees, from their layer 2, from their ETF custodianship, whatever, right? Then I don't think there's any target that really makes sense to care about. You just let it do its thing. You add on dips, you trim on rips, and you just let it go, right? I don't think there's anything to do here per se. This could easily pull back to 110 and keep going. I think it looks fine. It is interesting to me on the left here, I have the ARK sells. Kathy has continued to sell up here because she's had to rebalance based on her allocations in ARK and the other products. So even with this selling pressure, coin continues to go higher. And some of these sales she got a couple weeks back may come to haunt her or haunt ARK, you know, a couple months from now. We'll see. MSTR also looks fine. Just a vanilla pitchfork. 50% retracement would be 724. And it'll be interesting to see how this reacts to an ETF announcement. If that ends up being bullish or bearish, I don't know. We'll see. But chart looks great still. Marathon, kind of like Amazon, just looks great from a chart pattern perspective, from a cloud perspective. Marathon absolutely raking in those minor fees with the fee market exploding. And I don't think you could ask for a better looking chart pattern. It is a multi-month chart pattern. Even as me, a bear on the miners, just thinks this is a great looking pattern. And the cloud says, yes, 43. So we'll see what this ends up breaking to throughout the cycle. But I think 43 is a slam dunk no-brainer for that chart. GBTC, I think this trade's largely done. The discount is kind of hovering around 10%, 8%. The cloud likes it. This probably moves up with everything else on ETF announcements, assuming they get approved. Even if they don't get approved in the initial batch, maybe it doesn't matter initially for price. But the edge to edge is done, and the next step here would be eventual bullish continuation. ETHE, a little bit different, a little larger discount, has a little bit of ways to go on the cloud to 25, 26, somewhere thereabouts. So depending on your feelings of ETH products versus Bitcoin products, maybe you're selling GBTC and rotating into ETHE. Maybe you're waiting to do that till January. At this point, there's probably better trades out there just because ETH is lagging so hard. Personally, I'd probably rather trade BARA or the SMH ETF, which is a semiconductor ETF, which also looks great to me. That thing has a cup and handle and it's in price discovery. So until ETH starts to actually get momentum, ETH may just kind of languish until there's some sort of news catalyst, maybe mid next year, to move this thing higher. But overall, look, data is pointing in the right direction. That needs to be pointing in the right direction. And for the moment, it looks like we have dodged a recession that is likely to happen next year. But for the moment, we have dodged it. And we will continue to make all-time highs while the sun is shining. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.